Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video, I'll be walking you through of the key terms which we should be aware of before jumping into the regulation exam. So in this video, I'll be walking you through about category of taxpayers or filing status of the individuals or residential status of individual, including resident alien and non-resident alien, calendar year, tax period, depreciation, basis of assets, unemployment compensation, phase out, individual retirement account, and the boot. So all these key terms we'll be walking you through in this particular video. So let's dive into to understand more in detail. Now we are jumping onto the definitions and terminology which are different in US than India. The first one which I was telling you about the category of taxes. So in terms of category of taxes, there is federal tax, state tax, city or municipal tax. So these all are direct tax which we call, or income tax which we call, right? In addition to that, there is indirect tax which is sales tax, right? So that will also be there. But in the CPA curriculum, we'll be studying the federal taxation. So here is one thing I can share with you is income tax, right, which we are studying in US is being divided normally into three parts, which is being charged from the individual. One is federal tax, second is state income tax, third one is either city tax if the person is living in city. If they are sitting in some municipal corporation, then it will be municipal taxes, right? It is one of it, right? Either city tax or municipal tax, but not both, right? Normally the income tax which has basis taxable income remains same. So taxable income is generally same for state tax, city tax or municipal tax. Only the tax rate percentage are different, right? Normally, if I say the income tax rate for individual is, let's assume 25% or 26%, which is the federal tax rate. On top of it, depend on which state you are living. If you are living in a state of like New York, California, then state tax rate may be 8%. But if you are living in a state like Louisiana or maybe Alabama or maybe Florida or maybe Michigan, so state tax rates are in a range of 4 to 6%. In addition to that, if you are living in a state like Delaware or Arizona or like Guam, there is state tax law is tax is 0, right? That is also being there. So it again depend on which state you are living. So different state have different state tax percentage, but that percentage is applicable on the same taxable income. So if when you are doing the practice, for you it is being very easy. You need to understand in which state that individual is working and you need to apply that rate to it, right? Second thing is city tax or municipal tax. It is also being vary in a range of 0.25% to 1.25%. If someone is living in San Francisco, then it may be 1% or 1.2% to 5%. Someone is living in New York, then it will be higher. But if someone is living in a state like Detroit or city like Detroit, if someone is living in city like I would say Houston, or in city like Las Vegas, right, where like city tax rates are comparatively low, it can be 0.25 or it can be 5.5%, right? So it depends on city to city, same way like municipal to municipal as well. So that is what the difference. In India, if you say the income tax rate for all individual is generally a central government rate, but in US, the federal government, state government, city government or municipal government, they will take their respective percentage. Clear? Any doubt? So far so good.
So just to get more clarity. So you're saying particular income of maybe a corporation or individuals are taxed on multiple level. I mean, in federal taxes, state taxes, and municipal taxes.
No, when you say multiple level, that shows like double taxation. No double taxation, but the
Mhm.
taxes like in India, central government charge the taxes and then they
Mhm.
distribute to states,
Right, right.
right? Whereas they are clearly saying this I'll be charging and you can charge based on your state requirement, right?
Okay,
So some state
okay.
charge 4%, some state charge 6%, some state
So
charge
I think
2%.
okay, okay, sir. Understood.
Hmm. Right? Same way it is being
Thank
given to cities also, same manner, right? So it's like distribution from the
you.
government wide financial statement. If you see the distribution of their respective tax collection to the respective states.
Okay, sure, sir.
Hmm?
Thank you. Hmm.
Sorry, my throat is bad since from last 2 3 weeks. Next concept is the filing status. Like in India, we call it like individual, right? Or maybe assessee, right? But in US, there are five type of filing status for any individual, right? This is totally different. And when we get into the detail of filing status, I know it's very hilarious also. And you love like how they have categorized and why they have categorized in this fashion. So they have categorized in five, you can say, category for any individual to file their tax return. The first one is single. So single is the person who has never not married or never married, or who has got a legal divorce degree, and after the divorce that he or she can file himself or herself as a single tax return filer, right? Second category is for the married people. So there are two category for married people. One is married filing jointly. The second one is married filing separately, right? So like the married filing jointly is the generally most tax advantageous situation. Most of the tax benefits, I would say, is being higher for married filing joint return, and most tax disadvantageous position is married filing separately. And there is a reason to it. When you see, like when any government make any law, what they consider the general problem, right, of the country. The general problem of the country is, people are not living together. People are not making families. People are not trusting on each other, right? So what they have done, so that people have some additional interest to stay together, additional interest to make more families, additional interest to stay in the married relationship, they come up with certain additional tax benefits for the people who file a joint return, right? So joint return is is like interchangeable word I'll be using. Married filing jointly or a joint return are normally an interchangeable word, so I'll be using that. Normally in US, if you say, very less people like get into like married and family relation. They're more happy in living relation, right? That is creating a lot of cultural issue, health issues, and other problem in the society at large. To take care of this problem or to manage this problem, that lawmaker have come up with the special category called married filing jointly. Right? Married filing jointly mean that husband and wife they both are filing one return. Right? So they both are filing one return means they both are sharing their income, expenses, bank statement, social security, and other details with each other, and they file a joint return. Right? Like I know, like some of you might be married. No offense to anyone, right? How many of us are comfortable sharing our bank details with our spouses? How many of us are comfortable sharing our income, expense, credit card, debit card details with our spouses? I know there would be one or two, yeah, but no offense to anyone, that's the harsh reality, right? That's a harsh reality that people are not comfortable sharing their bank details, investment details, income detail, expense detail, credit card detail, right? But on the other hand, if you see who will be the most trusted couple on the earth, right? The couple who are being comfortable and open to share their bank details, income detail, expense detail, debit card detail, credit card details with each other. That means they both are trusting on each other. Yes or no? What do you say?
Yes.
I just see one yes.
Yes,
I
yes.
just hear one yes. I know. I know. Right. So the US government want like most of the people should get married and they file a joint return. So hence they have given extra support, extra advantageous situation to them. Right. When people are comfortable sharing all their income, expense, bank detail, debit card, credit card, and all those details with each other, it shows it shows they both are trusting on each other most, right? So when they are filing a joint return, they will get additional benefit to it. But on the other side, you are married and you are not trusting your spouse, right? Or you're not trusting your spouse as much as a marriage is required. So there is some disadvantages for that, right? That means if you're married, you have two options to file the tax return. One is married filing jointly. If not, then married filing separately. You cannot file any other status, right? And the married filing separately is one of the most tax disadvantageous position. That means you guys are in married, but you are not trusting on each other, right? That means you are cheating on each other, or you might not be fair with each other. So you should be get less tax advantage or less tax benefit. In the overall tax law, you will see that is what the theme is, right? Yes, in the last class, today class, and next couple of classes are being foundational classes, right? Where you will be understanding the theme, how the lawmaker has made the tax law. That is very important. If you understand the concept, how law is being made for the respective country, what is the culture of the respective country, then slowly and gradually it will be very easy for you to understand the overall US taxation and the other law which we'll be studying through, right? So married filing separately would be one of the most tax disadvantageous position, so that you'll be understanding over the period of time. Fourth one is head of the household. Have you heard this term before? Head of the household? Yes, no?
Karta.
Yes, in the last class, but it is not Karta. That I remember.
Yeah. So have we discussed what is head of the household?
Not in detail, but
Yeah.
it was, you just mentioned that it is not Karta.
Yeah. So it is not Karta. In India, it is generally like Karta is the senior most person in the family. But in US, the person who is spending the most for the household expense and maintaining the house is being considered as head of the household, who is taking care of the dependent and spending more than 50% of the expenses, right? So that also we'll be discussing in detail when we come to the filing status. Just here, like we are going through high level understanding stuff, right? So the person who is spending more than 50% of the household expense and taking care of certain dependent in the family is can be filed as a head of the household filing status, right? There would be certain condition which we'll be discussing in detail, but this position is slightly better than single less than married filing jointly. So it will be slightly more beneficial, but not that as a married filing joint return, right? Next one is qualified widower with the dependent child. Qualified widower can be male, can be female, right? And one more thing I wanted to bring into your attention. When I say married filing jointly, right, it can be of any sex. It can be male and female, it can be male and male, or it can be female and female, right? All kind of sex who are married, because marriage is legal over there in United States of America, they can file as a joint return. Right now, coming to the qualified widower. Qualified widower can be male or can be a female, but he or she, after the death of the spouse, is continuing taking care of the child, and they must have a child who is a dependent child. It's not like independent child. Then there are certain conditions. If you are meeting those conditions, you can file a return as a qualified widow, right? So first condition, like we'll be discussing in detail about all the condition, but few important you can say condition I can give you high level overview. Is first is, like before the death of the spouse, you both must be filing a joint return, right? Because the qualified widower will get all the benefit of joint return for next 2 years, right? But there are certain conditions which need to be followed. That means before the death, you guys were not liking each other and you guys were filing separate return. But after the death, you cannot start saying that I was loving my spouse, he was so honey, so hubby. No, that's not acceptable in the law, in the eye of law. If before the death of the spouse you both were filing a joint return, then only you can consider the qualified widower status. That is equally beneficial like a married filing joint return, right? They will be filing a joint return in the current year, in the year of the death of the spouse, and after that 2 year he or she should not remarry, right? He or she should be taking care of the child who is a dependent child. Then he or she can claim as a qualified widower status, which has almost similar benefit as a married filing joint return for next 2 years. So we'll be discussing in detail. So these are the 5 type of filing status, right? Any doubt?
Sir, can you repeat the head of household? Like you mentioned, 50% of the expenses.
Yeah. So the person who is taking care of some dependent, one or more dependent, plus he or she would be paying more than 50% of the household expenses for maintaining the house as well as the dependent, right? That person can claim as a head of the household position, right, Rakesh?
Okay.
Yes, sir.
Mhm.
You have already mentioned the third paragraph on the non-resident alien. So,
Yes.
we'll be discussing more about their category as well, because we see lot many Indians are there, and
So
they offer it. And
yeah.
another question related to this, we'll be discussing the investments for tax exemptions like social securities and all those things.
Yeah. Everything is
Okay.
part of it. Yes.
Okay.
We'll be discussing those things also, right? Okay. So now the next concept, which is different in India compared to US or in US compared to India, is the residential status. So in US, there are 2 type of resident, right? One is resident alien, second is non-resident alien. What is alien?
Not local person, born and brought up there.
Yeah, but in general, what you say, the alien who is coming from different planet.
Planets.
Right. So in US they say like anyone who is coming outside from the United States of America, they are alien for us, whether It can be a resident alien or it can be a non-resident alien, but for us, they all are alien, right? So the first is like citizen, second is resident alien, and third is non-resident alien. Resident alien and citizen from the tax perspective is have the similar treatment, right? Hence we'll be covering in a one go. So the resident alien status will include the citizen, the green card holder, or any individual who got married with the citizen of the United States of America, right? And there is a physical residency test that also we'll be discussing later on. That comes under the resident alien. And all other is being considered as a non-resident alien, like people like us who are visiting in United States of America for work purpose, for meeting purpose, travel purpose, training purpose, right? For any such things, right? So that is a different terminology which we are not exposed to in India. Next is the calendar year. So most of the individual follow the calendar year. That is January to December is their calendar year, is their tax year. And the return filing date is 15th of April in the following year. Normally 3.5 months after the tax return, right? If you see, like this is the tax period they have started. Like most of them, they receive withholding tax certificate in the month of January, so that February, March until 15th April is extremely peak season for the US individual taxation. This time you'll see like a lot of US CPA firm provide outsourcing work to India as well, right? If you see, like I don't know whether you have any idea about like number of the tax preparer in US and India, but just for the benefit of everyone, as we are studying the tax law, I can share the scope of taxation as a CPA in India as well as abroad. You won't believe it. Like any idea what is the total population of US by any chance? Anyone know, like, what is the total population of United States of America? Are you guys here with me? Oh, you have a good friend called Google that can help you.
Says
Right?
33 crores.
Yeah, almost 35 crore roughly is the population of United States of America, right? Can you guess how much percentage of people would be filing their tax return, individual tax returns, out of 35 crore population? Like how many percentage of people would be filing tax returns? Any guess you can make?
I think everybody has to do it, so I think the percentage will be
Mm-hmm.
higher.
Mm-hmm. Yeah, Daniel says 60%. Any other guess?
So you meant to say under all categories or only?
Yeah. All category. How many people, like
I think
out of
90 plus
Plus
percent.
the 90 plus. Yeah.
90 plus 98, Pooja? Any other guess? Right, like in total population, there would be certain people which is like below tax limits, and there would be certain people who are maybe kids who are in senior citizen may not have taxable income.
59. So it says 60% is.
60, 30. On an average, like as per IRS, almost 19.8% of the US people file tax return. So almost 20%. Right? Because there would be like kids, there would be like senior citizen, there would be people who are unemployed, there would be people who are below the tax filing requirements threshold, right? And there would be people like who do not care. Right? So as per IRS, 19.8% approximate people are filing tax return. Let's assume 20%. So what is 20% of 35 crore?
to proceed.
What is 20% of 35 crore?
7 crores.
7 crore.
7 crore. That means each year 7 crore people file income tax return, right? Yes, no,
Yes.
right? You won't believe it. In US, in total, I would say we have less than 57,000 US taxation expert in the US market, right? In India, do you know like what is the population of India?
Yeah. 130 billion.
Yeah,
But
around 140 crore.
yeah.
Right? In 140 crore of population of India, do you know like how many people do practice in or do have an understanding of US taxation to file the tax returns of US people out of 140 crore population in India?
Less than 1%.
Yeah. It must be less than.
1% is how much of 140 crore?
Yeah. That is also high. That is also high.
Yeah, less than 1%.
What is 1% of 140 crore? 1.4 crore.
1.4
1 crore 40 lakh. How many chartered accountant we have in India? Less than 5 lakh.
5 lakhs.
Right? Yeah, Pooja, you are very close. So almost 9,200 US taxation experts we have in India in 140 crore population. And you won't believe it, out of those 9,400, more than 7,400 are already settled abroad. In India, currently, we have less than 2,600 US taxation expert. You won't believe it in 140 crore population. Right? And on the other side, if you see the opportunity for practice in US taxation is humongous, humongous. You have seen like demand and supply gap. 7 crore people need to file tax return. In total, we have less than 60,000 people who are US taxation expert. Combined together, India and US, I would say. Right? So the opportunities are humongous and earnings are also really awesome. To be very honest, like in the last week, I was teaching this enroll agent batch, which is again a US taxation course specifically from the IRS. Right? There was one student who joined. Why he has joined enroll agent? Because like he got a referral from one of his friend to file a tax return for the US individual, and just for filing one tax return in which he has invested 40 to 45 minutes, he got $5,000.
No.
Right? So normally, if I say like I've been to US for almost 4+ years over there, normally any small size of CPA firm or small size of enrolled agent firm, right, they charge in the range of $200 to $1,000 for any individual to file their tax return. If you say bare minimum $200, which is almost 17,000 rupees, like in India, some of you are chartered accountant, and I'm sure most of you might be filing tax return. How much you pay? Right? Normally, we pay in a range of 500 rupees to 2,000 rupees.
Right.
Right, to the chartered accountant or to the lawyer. Right? Same time, if you are investing in international market, you can comfortably earn 17,000 to, I would say, 1 lakh rupees very comfortably for the same time. It depends in which market you are investing your time. Right? And especially like this 1st February to 15th April, this is extremely busy season. Most of the US CPA firm are looking for good partners in US. It's flooding. It's flooding, to be very honest. Same way, like we have some business taxation also we will be studying. Their peak period is starting from July, August, and September. Right? And then there would be extensions also. Like 6 month is auto extension. Why IRS has given auto extension? Because they know there are very less tax prepared. It's not practically possible for them to file the tax return of all. So they have allowed 6 month auto extension. That means 15th April is due date of filing of tax return. If you have not filed, there is no penalty if you file before 15th of October. But you need to make sure your tax is being submitted before 15th April. Right? We'll be like, as we go through the taxation part, we'll be discussing a lot of strategies, or you can say tax advice which you can give it to your client, and how you can save that on taxes for your respective category of client, but not the tax evasion, right? That will not be discussing. Next is individual tax return filing date, which I said like 15th April, and 6-month extension is available without penalty, but that is for tax filing return, tax filing return, not for the payment of taxes. If there is any payment of taxes are due, that you need to make sure before the 15th April to avoid any interest and penalty. And in India, we call it assessee, right? In US, we call it taxpayer. So that is a terminology different, which we will be going through, right? This, yeah.
Yeah. So I was saying, what about people who do not file within the extension of 6 months as well?
So there would be penalties. So we'll be discussing the penalty clause as well for not filing, late filing of tax returns.
Yeah. And maximum, till when does it go?
Say that again.
And maximum time by when they can file, like 1 year, 2 year.
Yeah. So yeah, I think so, like till next April.
Okay.
So 1 year. Yeah, then they cannot go back and file the return.
Okay.
But there is an amendment of tax return, that is Form 1040X. You can file some tax return. If, for example, you missed out on anything, you can, before like any demand comes to you, make sure you're filing an amendment. That also, like, many people do.
Okay, thank you.
Yeah, Shubham, you're saying something? Shambhu, I think you said something, or Ragesh?
No, I was not.
No, sir.
Okay. And this
tax return preparers, SSC is different, no?
Sorry, your voice is not clear. Tax return
preparer, the previous point that you mentioned, you said taxpayer is an SSC in India, whereas a tax return preparer is someone who helps the client.
Yes. So like tax return preparer, CPA or enrolled agent. So only 2 people.
Okay.
Yeah, right. Thanks for pointing out. Sorry, I missed to explain this. So taxpayer, same way how we have assessee in India. Tax return preparer who support the client in filing their tax return, that is CPA or enrolled agent. Right? They both get license. If you have CPA license or if you have enrolled agent license, then you need to mention your license detail when you're filing the tax return for any other taxpayer. Right? This is very important. So I would request you guys to make the note on the first page of your book, because like entire tax law when we are studying. So this is something I'll be helping you connecting back each time. This is computation of income for the US tax purpose for the individual taxation. So first of all, we'll be understanding in detail about the gross income. What all things comes under the incomes of an individual. Then we'll be discussing deduction or exclusion from gross income. What all things you can reduce from the gross income to arrive at the adjusted gross income. So after the adjusted gross income, you can take benefit as either the standard deduction or itemized deduction, whichever is more beneficial to your client or to yourself. After all this deduction, you will reach to the taxable income. To that taxable income, you'll be multiplying the tax rate. So tax rate is also like slab rate over there. So that also we'll be discussing. So after application of the respective tax rate for the respective taxable income, you will reach to the tax liability of an individual. After that, you'll be reducing the tax credit, withholding tax, advance tax payments, if there is any. Right? Then remaining amount could be net income tax payable, or it can be refund also. So this is how the overall flow of the computation of income. So I request on very first page, you can note it down this, because in the entire regulation US taxation part, we'll be going through one by one each topic, and I'll help you connecting back to the computation of income. Let me know once you are done. Done, everyone? Only this part, if you can just note it down. Or maybe on the last page, or maybe in your notebook, because every time we'll be coming back to this computation of income. Right? Done, everyone? Just give me a thumbs up.
Yes.
Yeah, Pooja, Shambhu, Prakash, Shezi, Sadaf.
Yes.
Done, everyone? Matthew, Akimuddin, everyone done? Okay, that's
Yes,
good.
sir, done.
Okay, so after that, like itemized deduction and tax credit, this we have discussed in last class also. So this is different, from the India. So in India, you'll get standard deduction as well as section 80 deduction both. But in US, you can choose either standard deduction, or it is called itemized deduction, whichever is more beneficial to the taxpayer. Itemized deduction include certain percentage of medical expenses and insurance paid, state tax and local tax paid, home loan interest and premium, charitable contribution, investment expense, casualty and theft loss, travel and entertainment expense. And then there would be certain tax credit. Same way, like we were discussing in the last class also, that certain investment, right, provide tax credits in India. In US, like in last class, if you remember, we were discussing about foreign tax credit. That means certain taxes you have paid in foreign country, for that you are getting the credit based on double tax avoidance agreement or tax treaty, right? Same way in US, on certain expenditure, there are tax credits available, right? Which include like foreign tax credit, expenses, child care credit, education credit, contribution credit, general business credit, and withholding tax. That also we'll be discussing in detail. Another topic is passive activity. This also I think we have touched base in the last class, right? So which is like passive income generated through the passive activity. Passive activity are those activities in which you or your client or the taxpayer is not being actively involved. So we'll be understanding in definition in detail about what is the definition or what is the number of hours is being resulted into the active activity, and what all things need to be considered for passive activity when you say any activity as a passive activity, or when it is being considered as an active activity. Then in terms of property, this also I don't think so we have touched with this last class. So property, like same way in India you have like property, plant and equipment, right? What all things comes in property, plant and equipment? Can you help me explaining? Yes, no? Hope this is not a difficult question. What is property, plant and equipment? Are you guys here with me? I just need 5 minutes more. Then after we can take a break, but at least for 5 minutes, if you can respond. Yeah, I see. Yeah, very good, Pooja. Yeah, Sam. Land, building, machinery, tangible assets, right? Very true, very true. So, same way, how in, in India, you have studied property, plant, and equipment, right? Property, plant, and equipment include land, building, plant, machinery, equipment, office equipment, automobiles, right? All those things which are being tangible assets, right? In US, those tangible assets are being considered in two categories: real property and personal property, right? So real property are those property which is land or anything permanently attached to the land, right? What is called real property? Land or anything which is permanently attached to the land, right? Any other tangible assets are being considered as personal property. That can be your plant, machinery, equipment, automobile, computer, laptop, chair, table. Those all things comes under the personal property. Here, there's a very, very, very thin line between personal property and your own property as an individual, right? As the name suggests, personal property, you may get confused that is it my personal property which I'm not using for business purpose, or it is a business property, right? That is the reason I kept this topic in the terminology section. Here, personal property is not your personal property which you are using for personal benefit or personal leisure. Personal property is those property which is being used in the business, right? But is movable in nature. Make sense? Any doubt here?
Or is it, sir, the property that is owned by individual and not in the name of business?
As of now, we are discussing more about individual taxation. So it may be possible that property is owned by individual, but he or she is using it for business purpose, right? If he or she is
Right.
using it for business purpose, then it comes under the personal property category.
Like even for a professional who's working in the office, but since we are going through work from home scenario,
Mm-hmm.
the person has arranged like laptop,
Mm-hmm.
printer, and all those things to be used for his to complete his professional work where he is being employed. But it
Mm-hmm.
is been owned by him,
Mm-hmm.
not been provided by the employer.
Mm-hmm.
All those
Yeah,
things are
like you're sorry to interrupt you. You are going in a wrong direction, because when you are working for someone, you'll be under employment. Depreciation you can charge when you are self-employed. Like for example, you are running a consulting firm, CPA firm, or US taxation firm or advisory firm. So this is about you're relating to the depreciation part. As an employee, you will not be claiming any depreciation. Make sense?
okay.
So when you are like self-employed or you are in sole proprietorship, you are in partnership, where you will be planning to claim depreciation on the assets. So we are discussing about that, right? Clear, everyone? Next thing is depreciation method. So in US, in India, like you guys are exposed to two type of depreciation, right? What are those two type of depreciation which you know?
Straight line and weighted average.
Yeah, whereas in US, the major or uh, most of the time used method is called MACR, 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 Modified Accelerated Recovery System, right? This is very different, which we are not exposed to, which we are not used to in India, right? And this is the most preferred depreciation method. If you are not using MACR, then you can use alternative depreciation method, right? If your first preference is MECA, if you are not using MECA, then you can use alternative depreciation method. And alternative depreciation method is similar to straight line method of depreciation. But in MECAR, there are conventions. Sorry. There are two types of convention. One is for the real property and second is for personal property. For real property, it is mid-month convention, and for personal property, there are two types of convention. One is half-year convention, one is mid-quarter convention. What is this convention and how it is being used? When I say for real property mid-month convention, it means during the year or during the month, whenever you have purchased the property, in the month of purchase, you'll be taking only 15 days depreciation or half month depreciation. Right? Same way, when you are selling the property, irrespective of the date, when you are selling the property, you always take half month depreciation in the month of sale. Right? If you are purchasing the asset on first day, second day, third day of the respective month, right? Normally in India, you'll see you'll charge the depreciation for the respective days, right? Whereas in US, for the real property, you'll be charging depreciation for the 15 days of that respective month. Clear? Real property mid-month convention. Clear, everyone? Yes, no? Are you guys with me? Or you need a break?
It's not that clear. I mean, I think we will need to develop the concept.
Yeah, so I'll reiterate. So mid-month convention mean irrespective of the date you have purchased in the month, but in the month when you have made the purchases of real property, you'll be charging only 15 days depreciation or half month depreciation. That is called mid-month convention. Right? Same way in the month of sale, irrespective of the date when you are selling, in the month of sale, you'll be charging half month depreciation. That is called mid-month convention method. Right? In the month of purchase and sales, irrespective of the date, you'll be charging half month depreciation. Clear now?
Yeah.
This depreciation charge would be what, like the modified accelerated cost recovery?
Yes, or yes.
Okay.
So the modified accelerated cost recovery system depreciation, you will be charging for 15 days in the month of purchase, 15 days in the month of sale for the real property. Now there is a second category called personal property. In the personal property, you will be having half-year convention method, or you can choose mid-quarter convention method. Right? So in the half-year convention method, that means you will be charging depreciation for half year, right? For let's assume H1 or H2, first half or second half. Jan to June is H1, July to December is H2. Whatever the number of assets you have purchased in Jan to June, you will be charging half of that depreciation for that respective half year, and the H2 will be full. Same way, whatever the assets you'll be purchasing in H2, for that you'll be charging depreciation for 3 months only. Same way for the sales also, right? Don't worry, we'll do some practical question also. So here I'm just sharing the conceptual difference which you are not exposed to, right? The next is basis of assets. That is very common, like basis of asset at which the asset need to be valued. Your cost of acquisition, import cost, delivery cost, installation cost, if there is an improvement cost, that all you need to load. Minus if there is any depreciation you have charged, right? Or if there is any impairment, right? That will be the basis of asset. Next is unemployment compensation. Unemployment compensation is income received by individual from federal or state government for loss of job or loss of income. That is being taxable as a salary and wages. right? Next topic is phase out, right? Have you heard Robin Hood rule by any chance? Have you heard this term called Robin Hood? Do you know Robin Hood?
We know Robin Hood. He was the taking from the rich and giving to poor.
Yeah. So in entire tax law, all these deductions and credits are based on this Robin Hood rule. That means if your income is less, you'll get more deductions, more tax credit. As your income keep on growing, that means you are getting richer. So government will give you less tax credit and less tax deductions, right? And this will be phased out over the period of income. So over the amount of income, right? So that we'll be discussing for all itemized deduction as well as for the tax credit. It will get phased out as and when slowly and gradually your income will start getting more and more. Next is individual retirement account. I think some of you are telling, are we studying those? Yes. So in the individual retirement account, there are three categories of retirement account. Like this terminology is different from India. In India, we call it like pension funds, right? Same way how in India you deposit in pension fund and after the retirement you'll get the pension. In US, it is called IRA, individual retirement account, right? So there are three type of individual retirement account. First one is Roth IRA. Second is traditional IRA. In traditional IRA, there are two type of traditional IRA, deductible and non-deductible. So deductible IRA means today when you are depositing, when you are contributing to the internal individual retirement account, you will get that itemized deduction. You will get that deduction from your income, right? But later on, when you receive the money, the amount is taxable. Interest and dividend is also being taxable. Whereas non-deductible IRA, when you are depositing the money, at that year, it is not considered as deductible. There is no deductions available for that. Hence, in the year when you receive money back, so it is tax-free. But interest or dividend will be taxable in the year when you receive. As the name suggests, Roth IRA, this is new age retirement accounts. Now, in Roth IRA, they all are non-deductible. That means in the year when you are depositing, you will not get any tax benefit. But in future year, when you receive money, it is tax-free. Principal as well as interest and dividend, everything is tax-free. So that is the benefit of Roth IRA. So we'll be discussing in detail, don't worry. But these are different terminology which you are not exposed to. Next is boot. Any idea? Anything you can imagine out of boot? What it will be? First time when I heard this term, I thought it's shoes. Right? But it's not. It is the cash you receive in the barter transaction. Right? That is called boot. It means when you are bartering, when you are making a non-cash transaction, but there is some amount of cash is being involved, that limited amount of cash is called boot, right? For example, let's assume you are living in Bangalore and I live in Delhi, right? Sorry. I have a piece of land here in Delhi and you have a piece of land in Bangalore, right? Your piece of land is, let's assume, has value of $1 million and my piece of land has around $900,000 value, right? I wanted to do some business in Bangalore and I was looking for such property, and you wanted to do some business in Delhi and you are also looking for the property which I have. So we reached to a conclusion that I'll transfer my property to you and you will transfer your property to me. In addition to my property, I'll give you $100,000 cash. right? Then the fair market value will match. Yes or no? Right? So this $100,000 is called boot, right? Then there's a qualified small business, which is like a startups, right? So there are certain benefit for a investor to do investment in qualified small business that we'll be discussing. Alternative minimum tax, whereas in India we call it MAT, right? So that terminology is different. And then self-employment tax, which is, like when you are in sole proprietorship, partnership, then you need to pay certain taxes for yourself. That is called self-employment tax, which we are not exposed to in India. For individual tax filing, the form is 1040, which after the break we'll be discussing in detail. 1040X is the amendment of the income tax return filing of individual, right? And 1065 is the form for filing the partnership return, which is informative return. And 1065 you can use for S corporation when you are using the pass-through entity, right? So these are the terminology I thought to share with you in advance before we jump more into detail. Now, we can take a small break for 15-20 minutes and then we'll jump onto the remaining part. So remaining part, like after this break, we'll be going through two things. One, I'll be walking you through the IRS website, what all resources are being available, what all forms are being available. After that, I'll be walking you through form 1040, which is income tax return filing form of the individual. In addition to that, the respective schedules which is being required to file the individual tax return, right? Then we'll jump onto the chapter 4, right?
Sir,
So, yes, Rakesh.
just one small question.
Mhm.
I've been doing accounting for one of my US clients, and they follow a process of recording an asset. When they purchase an asset, they record it on the first day of the month, irrespective of any day. And when they sell any asset, they record it at the last day of the month for the purpose of calculation of depreciation. So, what exactly they are they not following my?
That is for book purpose, sir. That is for book purpose.
Okay.
So there's always be like depreciation is always be different for book purpose and tax purpose, and it will always result into either deferred tax asset or deferred tax liability for book purposes.
Okay.
Right? So this is like 12:45. Maybe we can take a 15-minute break, come back at 1 o'clock, right? Let's come back at 1 o'clock.